Okay. Well, thank you everybody for joining today. We're going to get started. We're going to be on time. We're going to have people showing up, straggling in here. And when they do, we'll have the recording available for each and every one of you on our website. We actually have it at ccimla.com. And we are also going live on Facebook and on YouTube. So for those of you who are planning to, who are wondering if this can be recorded, do not fret. We will have it on our YouTube channel available for you. So we'll get started. DJ. Or Pia. Yeah. First and foremost, thank you everybody here for joining today. We want to be able to thank our sponsors for supporting our chapter. As many of you know, we are a nonprofit trade organization, and we rely on our membership and on our sponsors for all the programming that we do. And we appreciate all our speakers and our sponsors for participating, and to share a little more about our platinum, our silver sponsors, our bronze sponsors, and all of our members that help support us, that have these programs happen. Continue on. So real quick, we're gonna introduce the topic first. And the topic today that we're gonna be reviewing is the partnership tax considerations for real estate syndicates. So we have here today our speakers who are actually going to be doing more of a presentation for you today. This is not going to be like we typically do, or a panel with questions and a pretty dynamic, fluid conversation where you have a Q&A in the middle of everything. We would ask that each and everyone have their questions and answers plugged into the platform in the Q&A section, and we're actually going to have a designated time period when we're actually going to review all of the topics. Okay, so I'm gonna give a quick 2-minute thing about CCIM. DJ, if we can go back a slide. First of all, for those of you who don't know about CCIM, who are joining us for the first time, CCIM is the Certified Commercial Investment Member. This is a global designation that is provided for the commercial real estate industry. And for more than 40 years, CCIMs have been recognized as experts in the commercial real estate industry, and backed by the most challenging commercial real estate education program, which is one of the key aspects of our organization, is that we have an entire education platform that is offered to our not only our designees, but also our candidates and community. For today, there are nearly 10,000 professionals that hold the CCIM designation throughout North America, Europe, Asia, and Africa. So commercial real estate users, there are owners and investors that recognize CCIM as their first person to call for advice, direction, and analysis in commercial real estate. So for those of you who would like to learn more about the organization and about what the designation offers, please feel free to reach out to myself. I'm the president. My name is Francisco Williams. I am the current chapter president for the CCIM Greater Los Angeles chapter. At the end of the presentation, we'll be able to have contact information available for you, and ways for you to get involved and learn more about the programs that we're offering. For many of you that have been following us, our education has been put on hold for a period of time, but now we do have great news. We will be having in-person classes, and a schedule will be provided, I think within the next month or so. If not, they will already be posted on our website, and I can provide more updates for you later. But without further ado, I would like to have Stephen Morris introduce himself and tell us a little more about what he does, what his firm offers, and to see how we can, if he can give us more about his background. So Stephen, take it away.
Hello, everyone. I'm Stephen Morris, and thanks so much, Francisco, for the introduction. And we're so excited to give you a presentation today. So I've been in real estate tax, real estate accounting, real estate for the past, I don't know, call it 16 years. And I'm a CCIM like most of you guys are. And so aside from doing all the tax and stuff like that, I got into hotel developments, apartment developments, working with international investors, and I do a lot of stuff here locally in Los Angeles, a lot of ground up multifamily. My firm primarily focuses on small to mid-sized businesses who have a very heavy real estate focus. And so if you're that type of person who's looking for tax advice relating to, gosh, I don't know, how to depreciate your property, how to look at deals from a tax perspective, we're the guys for you. And so feel free to reach out after the presentation. And I'll introduce as well Diana Tang here, who's my partner.
Hey everybody, I'm Diana Tang. I'm a CPA and also have my master's in business taxation from USC. Although I am a Bruin at heart, went to UCLA for my undergrad. I joined Stefan in January of 2021 from actually over a decade of tax work at Ernst & Young. I was a senior manager there in the financial services group and worked primarily with private equity and hedge funds. And really what that means is I did a lot of partnership tax and saw a lot of different basically industries that they invested in. And so a lot of times some of my biggest clients were involved in debt and in distressed debt, in real estate, and, a lot of special situations. I worked on a lot of international European funds. And so really kind of have joined Stefan here from a tax perspective and really excited to share a little bit with you guys today. And with that, I don't know, Francisco, if there's anything else, or if you want to just kind of hop right into the presentation.
We're going to hop right into it, guys. We're going to allow you, I know we were going to allow you to share your screen. The great thing about this, everybody, is that we have a PowerPoint presentation and it's very informative. So we're going to stick to the script. And Stefan, if you want to take it away.
All right, so I'm actually going to share my screen. Let me know if you guys can see it.
Yes, perfect.
Beautiful.
All right, we love it.
Looking good.
Stefan, take it away.
Yep, so let's go to the next slides here. And so here's us, we introduced ourselves. Okay, so let's move on to the agenda. So we got a lot of stuff we're gonna cover today. We'll talk a little bit about the forms of syndication, discussion a little bit about partnership basis and what that means. So this is a lot of tax heavy technical concepts. We'll talk about the impact of liabilities on partners basis as well. And then we're gonna talk a little bit more about passive losses, at-risk limitations. These are the type of things that, when we're thinking about real estate, we love our tax losses more than anything. We love positive cash flow. We also love tax losses exactly at the same time. And so we'll talk a little about what that means to be able to harvest those losses. And then, down the road, since we're talking about this life of a syndication, we're thinking about, well, what happens when one of the partners wants to sell or we want to liquidate them out? What are the tax implications to that? And some random operational considerations, which a lot of folks actually are not aware of as it relates to syndications in the tax world. And then finally, I know a lot of you folks are going to want to know what's coming ahead in the tax law. We'll give you what we hear. We can't give you a prediction of what will happen, but we'll try our best. So let's move on to what the advantages are. So if we're thinking about a syndication, why are we even bothering to do this? And so when I think about when I started out doing development, I didn't have a ton of money sitting around in a bank account, right, to just buy a bunch of land and do all the deals myself. So I had to collaborate with investors. And so the cool thing about a syndication is that if you want to get started, either, let's say you have the expertise, you've been doing development for a long time, you really know how deals work out great, but you don't have the money to do it, well, you can get a bunch of other people with money together and form a partnership, and they can pull all their resources together and allows you to get into a deal. And so if you're an investor, you're like, great, hey, I want to get into a large deal, but I just don't have a ton of money laying around. I'd like to be able to participate in something. Great, that's why we want to get into a syndication. The other cool thing is, hey, if you're an investor, the sponsor, the person who's running the deal is going to handle the whole show. You're not going to be out there in the middle of the night making sure that your construction site is secured or that the tenants are happy with their leases. That's all left to somebody else. And again, we're able to invest in large properties, large projects through syndication, which is one of the major advantages. So if we think about a sample deal setup, let's take Steve, the developer, he's the sponsor, and Steve doesn't have any money. And so he contributes no funds to the partnership at all. But he's got a balance sheet. Maybe he has a lot, maybe not a lot of liquidity, but he has a lot of maybe some other real estate assets. He has pretty decent net worth. And so he's able to guarantee the construction loan, because typically construction lenders, if you're going to build something ground up, they want a personal guarantee. And in addition to that, Steve knows how to build this building. So he's going to provide all the labor, expertise, he has all the connections with the contractors. In exchange for all that work and all that sweat, he's going to get a profit interest in the partnership. Okay. Whereas Albert, Bernice, and Clara, coincidentally ABC, they'll be the investors. And so all they're going to do is invest in the partnership in exchange for a capital interest. And so what A, B, and C is trying to do is just get a check that's bigger than the one that they wrote to the partnership. That's their ultimate goal, right? And so the way they'll agree to this deal, they'll say, hey, look, the partners are going to agree that all the distributions are going to go back to the investors first until they recover their invested capital. And then after that, any profits are split 80% to the investors and 20% to the sponsor, which would be Steve, and he'd be very happy if that happens. So as we're going through this presentation, think about this kind of deal setup, and this might be a typical kind of syndication for maybe a small multifamily ground up construction. So these are the ways that they can do it, right? They can form it into a corporation, they can go into an LLC, they can do a general partnership, they can do a limited partnership. These are all great things. And so limited partnerships overall are the most common form for syndications, but limited liability companies are great too. And from a tax perspective, they're pretty much the same thing. And so if we think about it, managing member, Steve, he's going to organize it. He'll file the articles of organization with the appropriate state. He'll operate and he'll do all the work and everything like that involved to get the property up and running. And like I said, the members invest the capital, but they're not going to participate. Generally speaking, right? I mean, this is how the deal should work, is that A, B, and C should stay silent throughout this deal while Steve does what he's got to do with the money. And so they're passive as a result. And so there's not going to be this double taxation because we have a partnership, and this partnership passes through any income and losses to its member. Well, primarily it's income, income to its losses to its members, to avoid a double taxation event like what would happen in a corporation.
All right, so now we're kind of formed as partnership, right? And so what is important when you think about partnership taxation? One of the most important concepts when you think about partnership taxation is basis, because basis is governed by section 742, 705, 722. But what does that really mean? It determines how much gain or loss you have at the end of the day. It determines whether or not you can take losses currently, right? And we'll get into that a little bit later, but basis is definitely the most important kind of factor when you think about partnership. And so your outside basis is really initially determined by your contribution or transfer in whatever money you're putting in, right? And so here you see partner A, B, you have the outside basis, which is your partner's basis. Partner A is putting in $100, partner B is putting in $200, and then you have an inside basis, which is your partnership's basis. So there's a difference between outside basis and inside basis. Your outside basis is your partner's interest. Your inside basis is your partnership's basis. And so as you'll see here, whatever those partners are putting in is whatever basis you have inside the partnership as well. And so from there, as you kind of go on from year to year and you have operations, you have income, maybe additional contributions, distributions throughout the year, that will all adjust your basis kind of going up or down. For tax purposes, we all know we like capital treatment of income, right? Because we don't want ordinary, but for basis purposes, your ordinary and capital kind of income and expenses adjust your basis upwards and downwards equally. And so here, we'll kind of take a look here. For your individual partners, you really have to keep track of your outside basis, your partner's basis very well, right? Because that's kind of on you, not on the partnership. And each partner has a single basis in their partnership interest. Here you'll see kind of just an example of how your basis goes up or down. You'll see you start off with your contribution of $300. Income increases your basis. distributions reduce it, any losses will reduce it. And so you kind of end up with an overall ending basis of 275. And so one thing to keep in mind is ordering is important when it comes to basis. Your distributions will reduce your basis before losses. And you'll see why that matters in a little bit. And so when it comes to real estate, you guys deal with debt all the time, right? And so, you know, the great thing is that you actually get basis for your debt. And so, but there is a little bit of a difference between whether it's acquisition debt or if that's debt after you acquire a property. So if you have acquisition debt in a property, that actually gives you basis in that property. So let's just say you're going in, the partnership, you know, has $100,000 of capital, but then goes out and gets a mortgage for $900,000. Well, you know, you go out and buy $1 million property, that property still has a basis of $1 million because you still get basis for the acquisition debt that went into it. And really both recourse and non-recourse mortgages incurred at acquisition are included in basis. And we'll go a little bit more into kind of what recourse and non-recourse is a little bit later. And so if you purchase a property that already has a mortgage on it, you still get basis for it. And then if you sell kind of that property and it's still kind of encumbered by that debt, you have to include the amount of debt that the unpaid debt in the amount realized. So any relief of debt that you get is included in the amount that you realize on that property. If you know, if you mortgage the property after you acquire the property, you don't actually get basis for that unless you use those proceeds to improve the property. So just kind of keep in mind the timing of when you get that debt. And so remember we talked about difference between recourse and non-recourse liabilities, right? And so for recourse liabilities, these are partnership liabilities where a partner bears what we call the economic risk of loss. So basically you have a partner who's saying, hey, you know, if all things go down, I'm on the hook and I'm gonna have to pay that money back, right? And then what actually happens is this type of liability, recourse liabilities, provides basis for your partnership distributions and it provides at-risk basis. And we'll get into, again, at-risk a little bit later. I don't know if you guys have ever heard of that before, but you know, it's definitely something to keep in mind. And so typically, you know, if you have a smaller deal, smaller sponsor, and the bank, you know, feels you're a little bit riskier, of course, they'll probably, you know, push you towards that recourse loan, right? And typically because you have a sponsor who is taking on that economic risk of loss, what happens is the allocation of liability is different between kind of your recourse liabilities and your non-recourse liabilities. So in this case, you know, we'll come back to that example where partner A is the sponsor, he's putting in $100. You have partner B who's putting in $200. You got, you know, a total of $300 in the partnership, and then the partnership goes out and takes on a mortgage of $270. So now they got $570 to go out and buy, you know, the property. So they have a basis of $570 in the property inside the basis or inside the partnership. And so what does your outside basis look like, you know, between partner A and partner B? Well, you have that initial contribution between partner A and partner B, but because partner A as the sponsor takes on kind of that economic risk of loss, all of that recourse liability is allocated to partner A. And so they actually receive all of the basis. So what happens when you have a non-recourse liability? So under section 752, this partnership liability, no partner bears the economic risk of loss. And so what happens here is this provides basis for your partnership distributions, but you do not get at-risk basis. And again, we'll come back to this. However, when it comes to real estate, a lot of times, you know, that that mortgage may be secured by the property. And what this actually gives you is qualified non-recourse liability. And what that does, it actually does provide at-risk basis because, you know, there's property kind of on the line. And so the banks feel a little bit better about that, right? And so what does this mean when it comes to allocation between those partners? Well, remember, for your recourse liability, your sponsor kind of took on all of that economic risk of loss, so they got all of that basis. Well, now there's nobody, you know, other than that property and other than the partnership who's really taking on that liability. And so now you kind of allocate that liability pro rata. So, you know, a third goes to partner A and 2/3 goes to partner B. And you'll see that this gives you a very different kind of outside basis for your partners, depending upon whether it's recourse or non-recourse liability.
Okay, so the reason why we're talking about all this, again, as I mentioned earlier, we love tax losses because figuring out how to allocate income is pretty straightforward. We have a partnership agreement and it dictates where the money is going to flow to. And so it's pretty easy to understand. And if you're thinking about it as an investor, you get this K1 and this income goes in and you're like, great, I got to pay taxes on it. Wonderful. But like I said, we love losses. And so we want to have the avenue or the ability to take losses. And that's what we're trying to achieve here. And so, you know, we're thinking about this type of environment now that we're in real estate. We're kind of in a low yield, high basis kind of situation, you know, where nice deals look like a 5 cap, things like that. And so, you know, when you're thinking about depreciation, especially if you take into consideration like a cost segregation analysis, you know, you're probably going to be running tax losses for at least the first several years of your property. And you want to be able to take those against all the other, maybe presumably other income properties that you have out there that are generating taxable income. And so the question is, when can we take these losses? And so there's a few hurdles we have to consider first. So here's our man. He's the investor, and he's trying to get to the finish line to get those losses. So the first hurdle he's got to jump over is basis, right? And we talked about that basis. You got to have enough in there to be able to take a loss. And then there's this thing called at-risk basis, under Code Section 465. Then after that, you've got this passive loss consideration as well, right? And then if you can clear all 3 hurdles, then you get yourself a deduction. So again, what do we care about basis? Well, we know, first of all, basis can't dip below 0. And if we if we look back to the ordering rules that Diana mentioned, you know, losses can't take your basis below 0. So to the extent that you, if you have losses that are in excess of your basis, then you're just going to suspend them. You're going to hold on to them until one day you have enough basis to take those losses. And if you get a distribution in excess of your basis, right, then you got to gain. So that could happen in a situation where you have 0 and then they hand you more money. You're like, great, well, you got a taxable gain in that situation. And so let's look at this basis limitation here. So again, with partner A and partner B, partner A puts in $100. He takes a distribution of 75 and a loss of 50. That puts his basis at -25, but we can't go below 0, as we said. So 25 of it's going to be suspended. He'll be down to 0. And B has got the same similar situation, right? He's got -50 of tax basis. And again, can't go below 0 in tax basis. So we're going to hold those losses until one day we do have enough basis in order to take it. And by the way, just one last thing is the loss will be carried forward. So like I said, you have basis or you dispose of the actual interest itself. Okay. So we're going to jump around the hurdles a little bit. The passive losses, some of you may have heard about passive losses, and those are, and especially for non-real estate people, is a huge limitation in your ability to take losses against all your other ordinary income. So if we think about the past, I think it's prior to the Internal Revenue Code of 1986, there were a lot of folks who would invest in these cool little partnerships that threw off a bunch of tax losses, and they just were never involved in them. And so they generated all these losses and they were able to offset all their other ordinary income. And so Congress didn't really love that. And so they passed 469 and 465 in order to limit the investors from making investments in order to take these crazy large losses. And so what they ended up doing was making this very complicated code section, which takes a lot of time to master. And they said, all right, look, we're going to take income, we're going to move it into 3 baskets. we have this portfolio basket first. And so the portfolio basket relates to like interest income, dividend income, things like that. And then we have another bucket here, which is active income, right? So the active income would be like any business, any trader business that you're actively participating in. It seems pretty straightforward. And there are bright line rules, I should say, in 469. And typically it's like a 500-hour threshold, but there are a few others as well that I'm not really going to go into. But active is anything you materially participate in. And then passive would be, well, it's anything you don't participate in. And you have this opportunity to actually move things around and classify things in different baskets. And so one example might be like, let's say you're a bakery and you have two bakeries, one in downtown LA and one in Santa Monica. But you're always spending all your time in the downtown LA location as the head baker. And you just never spend any time in Santa Monica because you kind of let that thing run on its own. So you can actually segregate those two activities out. And then for your bakery in downtown LA would be an active, kind of be in the active basket. And the bakery in Santa Monica would be in the passive basket. Or you can make an election to actually move them both into the same bucket and say, hey, you know what? These are all this is my like bakery empire that I have here. And overall, I'm spending enough time between the two activities where then both become active like by default. And so that's a tax election. That's a consideration you have to make whenever you're considering multiple lines of business. So when it comes to netting these out, you can only net items against each other in the same basket. And so passive losses can offset other passive income, but you can't take net losses against portfolio or active income. And that's the main kind of annoying thing about passive losses, right? And there's a whole thing about real estate professionals being able to take that against their ordinary income. That's a lot of fun. You can talk to us about that after the call. But that's kind of the main hurdle. And so if we think about what happens to these losses, so you get this, if you can't use them, then they stay suspended, right? The code loves to suspend losses every which way possible. And so you can hold them until you have other passive income down the road. Maybe you buy more properties, maybe you gain more other passive activities. Or ultimately, disposition is when you get to take it. And so that's the kind of the last point where you can kind of unlock all your passive losses and be able to harvest them against your gains.
All right, so we talked about a bunch of hurdles that you have to get through. If that's not, complicated enough, you got your at-risk hurdle, right? And so your at-risk rules governed by 465, those also limit your losses. And this is actually, I feel like passive activity and, active activity, a lot of people are pretty familiar with, or they've kind of heard about, but at risk is something that's actually oftentimes missed and that people are not as comfortable with. And so what are the at-risk rules? So similar to passive loss issues, right? Tax shelters, not only generated losses, but they were highly leveraged. So, the IRS already doesn't like you taking losses, just for the joy of it. But what's even worse is if you went out, borrowed a bunch of money, and then took losses based off of basis that, that wasn't even really yours to begin with, right? You didn't put that money in. You went out and borrowed somebody else's money, and then you got basis for it, and then now you're taking losses. Well, IRS says, wait, let's go back. Let's think about that a little bit, right? And so really easy example is, hey, Duke goes in, invests $1 in XYZ company. The company goes, borrows 10. And then that company spends all $11, right? And then allocates the loss of $11 to Duke. So Duke has $11 loss that year because, just say it's a partnership, and for partnership purposes, all of that income is flowing directly to Duke, right? And he's taking it on his individual tax return. Well, now he's taking an $11 loss, even though he's not liable to repay that debt. And so what if, the company goes down and he never has to pay that debt? He just gets, the benefit of the $11 loss. And so the IRS says, all right, let's roll it back. We're going to come up with these at-risk rules under section 465. And who's, subject to these rules? Individuals and closely held C corps. And so basically you have to look at not just your basis, but your at-risk basis. And so when you think about what's at risk, it's kind of similar to your basis, right? It's, you take into consideration your cash contributed. If you contributed property, you get basis as well. Recourse debt will give you at-risk basis, and qualified non-recourse debt will give you at-risk basis. So you'll see what's missing here is just non-recourse debt, right? Because if recourse debt, you're taking on kind of that economic risk of loss. Qualified non-recourse debt, that's backed by a property. So, okay, you know, you're probably not going to run away with that property, but it's non-recourse debt that does not have an economic risk, that has a partner who doesn't have an economic risk of loss. That's where you don't get any at-risk basis. So what are, you know, non-recourse liabilities? They don't add to your at-risk basis, you know, unless they're qualified non-recourse debt. So again, what's qualified non-recourse debt? It's, you know, usually activity related to holding real property. It has to either be from a qualified person, government, or guaranteed by a government. They're fully non-recourse. So again, it's not a recourse liability. So again, no person is personally liable, and they're not convertible debt. So disallowed at-risk losses are, again, you can carry them forward, similar to the passive losses, right? And so this is something that you have to look at year after year. So you push those forward into the next year, you have to look at that year's, again, at-risk rules. If you have at-risk basis, you can take those losses. If not, you got to carry them forward indefinitely. And if you never kind of come to a place where you have at-risk basis, then you basically have to push those losses until that activity is disposed of. So again, your amount at risk, your at-risk basis can't go below zero due to losses, because you'll end up having to suspend them, right? But hey, what happens if you get a distribution of money or you have a reduction in your debt? So let's just say you have, you know, recourse debt or qualified non-recourse debt that was pushing up your basis, and all of a sudden, you know, that debt is paid off or it's shifted and you don't have that debt anymore. Well, guess what? If your at-risk basis goes below zero due to a distribution, because it's not like you're going to take that money and like try to give it back. You got that money, you got the money. And so what ends up happening is you're actually going to have to recapture any at-risk losses that you took previously to bump that at-risk basis back up to zero. And so when that happens, you know, you basically have an ordinary income event, because you're recapturing kind of the losses that you took in previous years. And so something that, you know, is that you might want to think of is, you know, if you're refinancing, right? Just say the bank comes to you and says, hey, you know what, you got a non-recourse loan right now, but I can give you a really hot rate on a recourse loan. And the sponsor comes in and they're thinking, okay, hey, you know, like, it's a good deal, I should take this. You know, why should I be paying, you know, X amount of points on this non-recourse loan when I can get such a good deal on the recourse loan? Well, you might want to think about the potential for at-risk recapture, because that debt starts to shift from your partners to the sponsor. And what does that look like in numbers, right? So let's just say, again, we come back to the AB example where you contribute $100, $200, and then you took on a non-recourse liability of $270, right? And so that's allocated ratably between partner A and partner B. And so, you know, you come to a basis respectively of 190 and 380. Let's just say, you know, in the first year, you take a tax loss of 145, 290, you get to at-risk basis of $45 and $90 respectively, right? And then that's when the bank comes in and tells you, hey, you know what, I got this really good deal for you, you know, let's switch that non-recourse liability to a recourse loan. And so you take it and say, hey, you know what, I'm gonna take that, I'm gonna refinance, take that recourse loan, and all of that debt, remember, is allocated to your sponsor, because they're taking on along the freaking economic risk of liability. And so they're allocated all of that debt, but you have to take into consideration that you get a relief of the non-recourse debt that you previously held. And so that lowers your at-risk basis. And so what ends up happening is all of that basis for your debt is shifted to partner A. So your at-risk basis for partner A ends up being 225, partner B ends up dipping below to negative 90. And so what ends up happening, remember that tax loss you took previously, you're gonna have to go and recapture that. And that comes in as ordinary income to get you back to kind of a zero at-risk basis.
I got to tell you, your partners, your investors, if you create the situation, are going to give you a few angry phone calls if this happens. It's not a tax event they probably planned for, so you should be very careful whenever you're considering shifting around liabilities. So let's talk about some other considerations. We gave you kind of a high-level overview of partnership taxation. There is so much more to it than what we talked about here. We can go on for maybe like another 100 CCIM sessions if you want to have us back, Francisco, for that.
No worries. We're going to have a series. If Stefan and Diana are willing, we will accommodate. No problem.
But there's other considerations specific to syndications. There's a method of accounting issue you need to consider. And then let's talk a little bit about what the sponsor's tax outcomes are, and then this whole carried interest discussion as well. So here's the crazy thing. A syndicate is actually considered to be a tax shelter. Now, don't worry. This is not like the hiding the money in the Cayman Islands thing and not letting the government, but they call it a tax shelter under the rules. And so if a tax shelter is actually considered to be anything where the 35% of the losses of the entity are allocated to the limited partner. So that almost always happens in the syndication, right? Because the limited partners usually get to harvest the lion's share of the losses. So when that happens, then the cash method of accounting for your partnership is actually unavailable to you under Code Section 448. You have to go to accrual. Not a big deal, but just something to consider, because a lot of folks in real estate think, cash is good enough for me. It's a small partnership. I don't need to worry. But this little rule here will trip people up. And it's kind of an unknown thing, because you have to look through like 3 or 4 different code sections to draw the conclusion that your syndication is a tax shelter. Especially when you look at I remember when the first time I read the code, it said, except for tax shelters, you can use the cash method of accounting. I'm like, I'm not a tax shelter. And then I'm like, wait a minute, let me actually read and understand what they define as a tax shelter. You got to look at what every definition is. You can't assume that And then that's when they came in with saying it's a syndicate and the losses and so on and so forth. So just be careful about that. If you do have a syndication that you manage right now and you're on the cash method, don't fret. What you can do is file for a change in method of accounting. That's accomplished on Form 3115, and you can file that with the commissioner before the tax filing deadline. So it's going to be too late. Well, no, you can probably still do it now by the extension if you haven't filed your return. But next year, you'd have to do it before the filing deadline.
And also, too, I'd also add that you consult with your attorneys to amend your PPM. It's definitely in your PPM. People miss that all the time.
Great. And so now we're thinking about the sponsor. So why did he get into doing this deal in the first place, right? So it's obviously to make money. Like, he wants to make some money for his work. And the other benefit is that he would like to earn his income in the form of long-term capital gains rate instead of this highly taxed ordinary income situation. And so remember, early on when we talked about this setup that we had, Steve, the sponsor, only took a profits only interest in the partnership. So the cool thing about partnership interest for services is that the receipt of a partnership interest in exchange for services solely is, as long as it's a profits interest, is actually not a taxable event. And you have a safe harbor under Revenue Procedure 93-27. And there's some caveats to it, right? So like, if you know that there's a certain stream of income coming in when you receive that profits interest, they're probably going to say, hey, that would mean that there was some value to that profits interest immediately upon receipt. And if you dispose of it within 2 years, then you have another issue as well, where you might have to recognize income earlier. And of course, if it's a publicly traded partnership, it doesn't apply. But the tax theory behind this is, hey, I'm receiving an interest in a partnership. I'm receiving an interest that's contingent on something happening in the future. It may be that we never realize income on this partnership, right? I mean, it may be that the property actually declines in value, or that the tax outcome doesn't work out the way we expected it to. Or I'm sorry, I should say the economic outcome doesn't work out the way we expect it to. So it's not fair to tax me on this theoretical value when it hasn't happened yet. And so that's the deal. Now, if you receive something like a capital interest, right, that's like a straight up, like, I'm going to hand you 20% of the whole deal right now. You immediately on day one, you own 20% of this apartment building. That right there, I mean, it's under Code Section 83A. You would actually recognize the fair market value of that property immediately upon receipt, because it's fully vested. You own it. It's not even a question that you own 20% of the deal, right? If they liquidated one day later, you would receive cash. And so it's only fair to tax that as income. But in the profits interest, like we said, this is contingent on an event that's uncertain, that hasn't happened yet. And so that's the reason why the code is favorable to sponsors in this situation. So here's an example of how this deal worked out, right? So in the initial year, so let's say all the partners put in $500, and so they have $500 in assets, and the fair market value at the time was $500, but it increased to $700. And so they have this, so I should say this whole of the partnership is $700. They sell the property for $700. The property basis is $450, and so they have this gain of $250, and then they also give up all the cash that's in the partnership to the investors. And so the way the deal would work is they first pay this $500 in cash to the invested capital first, because the investors want their money back. And so A, B, and C get 100, 200, and 200 respectively. And then there's this $250 gain. And so finally, Steve's really happy. Hey, for all the work and all the effort that he put in, he's going to get 20% of it. That would be $50. And so Steve gets 50, and then the last 80% is split pro rata between the remaining investors, A, B, and C, and they go 40, 80, 80. And the cool thing is Steve's not going to realize ordinary income on this. You know, if this is a sale and this is going to be a capital gain, and it's going to be most likely a long-term capital gain because the holding period would be greater than 1 year, then he's super happy. His tax rate's going to be somewhere between 15 to, call it all in, 23.8%, depending on where his income is. And so he absolutely loves that. But the thing is, in the Tax Cuts and Jobs Act of 2017, there's been a lot of backlash about this. And I recall it was like the 2012 election when it was Mitt Romney released his tax returns, that he was paying he made like $35 million or something like that in one of the previous tax years. And he had an effective tax rate of 17%. And so Mitt Romney was working in private equity at the time. And so he was receiving his money just like Steve was. You know, they'd buy these companies up, turn around all the businesses, and then sell them. And then once the sale happened, he would receive the capital gains. And at the time, the capital gains rate was just 15%. He would receive all of his income in the form of capital gains and pay a very low tax rate. So that felt kind of unfair. And this is still a highly contentious point in the tax code. It feels like, you know, there's a lot of kind of backlash around this. So Congress passed Code Section 1061 in 2017. I got to tell you, even today, the code is still not quite clear. There are proposed regs out that clarify it, but when they pass it, they sort of just pass the law without a lot of clarification. But right now, as it stands with the proposed regs, they're saying, all right, look, we're not going to get rid of this carried interest treatment altogether, but instead of a 1-year holding period to receive long-term capital gain treatment, Steve would have to hold it for 3 years. Okay. And so, and if it's an operating business, you know, it doesn't apply. And it doesn't apply in a situation where you're getting a capital, you know, when you're actually giving a capital interest. But the cool thing is, it also doesn't apply for Section 1231 property. And can you guys guess what is Section 1231 property? It's going to be rental property, rental real estate. And remember, this is the regs in the proposed form. You can rely on them right now. And so if you're in this situation that Steve's in, it appears that it does not apply. We'll see when regs go to final form if they're going to amend that or change it, because I'll be honest, when I was looking through the code and the regs, it seemed like the regs were contradicting the intention of Congress. But for now, this is where we're at. This is where it stands, and you're fine if you're in rental real estate. It seemed like more like 1061 was governed more towards like hedge funds and things like that, where these guys would get huge amounts of gains for selling stocks and bonds and all that. So it seems like for now we're off the hook, but we'll get more to that later.
All right, so let's look at some disposition considerations, right? And so what if, you just got a bad investor, you just they don't want to work with you anymore, you don't want to work with them anymore. How can these guys exit your partnership, right? So there's two ways. One of the ways is to purchase this partnership's interest. So basically, this partner's interest. So basically, partner A, let's say they want to get out. They're going to sell their partnership interest for basically their fair market value plus any relief of debt. They will recognize capital gain or loss outside of the partnership on their sale of their partnership interest. And what does this really look like? You got partner A here, initially put in $6,000. You have a partnership liability of 12. And so what they're going to sell their partnership interest for is that fair market value of 16, right? And so they're going to get cash of 16, but the amount that they actually have to realize is that 16 plus any relief of debt. And so they'll have kind of a third of their partnership liabilities that's relieved of debt, right? And so you get 16 plus the 4,000 share of liabilities, which gets you to a realized amount of $20,000 minus basically your $10,000 of outside basis, because remember your outside basis is your contribution in, which is your capital of 6,000, and your share of liabilities, which was $4,000, right? And so at the end of the day, you have a $10,000 gain. The other way is to liquidate partner's interest. And so what this does is, instead of having another partner come in and take, partner A's place, or having, the partners that are already within the partnership purchase partners A's interest, you have the partnership liquidate partner A. And so they have to use their assets or take on debt to liquidate the partner. And so the partnership has to do this. When you're liquidating a partner, the partnership has to be the one who liquidates the partner. Your other partners, you can't have those other partners kind of contribute capital into the partnership and then, pretend to liquidate, because otherwise that actually could be seen as a sale as opposed to a liquidation. And so this, typically liquidation is governed by Section 736 in terms of these, ordinary or capital treatment. A lot of times this relates to if you have a partner kind of retiring. So let's just say you're paying them out, that fair market value includes kind of future income that they would have earned. Well, that's actually going to be ordinary income to the partner, and your partnership can actually deduct that, payment to the liquidating partner. But you have to remember that it's also subject to self-employment. Under Section 736B, if there's, goodwill that's included in that fair market value, and typically this is something that you'll see in like capital intensive partnerships, that'll be capital to the partner and non-deductible to the partnership. So what ends up happening is, if you remember, I mentioned that partner ends up recognizing a gain outside of the partnership, right? And so what this ends up doing is it actually creates a disparity between your inside and your outside basis, because you have a partner coming in at the fair market value versus, the partnership basis that's inside the partnership, right? And so what can you do to kind of, equalize this disparity? You can actually make a Section 754 election. And what this does is you can actually step up the basis within the partnership. And then you can have that kind of higher basis within your partnership to depreciate at a higher value, right? But you have to, things to kind of consider when you make this election is, this election, once you make it, it's kind of there forever. So it stays in effect until, you go to the IRS and say, hey, I really hope to kind of rescind this election. And the benefit, again, is that you're allowed to take additional deductions. So let's just say you step up the basis within your partnership, your inside basis goes up, you can take additional depreciation on that higher, basis, right? But disadvantages are, hey, if you have those rules to stepping up, you also have the same rules for stepping down. So let's just say the fair market of your property declines or another sale occurs, you actually have to step down the basis of your assets. So again, remember, your election stays in effect, whether it goes up or it goes down, right? And again, it creates a little bit of additional accounting because then you kind of have to maintain a separate set of books to track kind of the adjusted assets. And so what does that mean in numbers? We'll just walk you through a quick kind of example. In that initial year, coming back to A, B, and C, contributed $500. They bought a property for $450, right? And so right before the sale, the fair market value of that property goes up to $700. Partner C is getting out, and partner D is coming in. So at that point in time, the fair market value of partner C's partnership interest is $300. So D buys in for $300. And so you can see here, your assets and your equity are a little bit different, right? Because this is your equity at this point is representative of your outside basis, which D has an outside basis of 300 because they bought in for $300, and your assets within the partnership is still at that 500 because you still have kind of the 450 of the property and $50 of cash. And so there's that disparity of $100. If you decide to step that up, what ends up happening is within the partnership, you step up that property to the 550 for that additional $100 that partner D bought in for. And what's nice is you get to depreciate, that property at the $550 value versus the $450 value without the step up in basis. And that additional depreciation is all allocated to partner D.
Okay, so I know you guys totally got all of the discussion about our partnership taxation rules, and you totally mastered it right now.
Absolutely. Wow. This is.
You know it now? Perfect.
No doubt. This has been
so we'll
incredible.
retire, and then you guys can do all the partnership tax returns going forward. That'll work for us. All right, so here's the fun stuff. I know everyone's looking forward to what comes next. And again, like I said, huge caveat, it's not certain exactly which one of these rules is actually going to pass. But these are the proposed changes. And so we'll get into a little bit of them, right? So the first one they're going to target is going to just raise the top marginal rate back up to 39.6% as it was prior to 2018. They're talking about this taxation of capital gains at ordinary rates for high income earners, which is going to be it's going to be very interesting. The transfer of, this is going to be a huge one, especially for estate planning purposes, and you may want to consider doing this now, is that if you transfer appreciated property by gift or death, that becomes a realization event for income tax purposes, which is pretty crazy. Then investment income and self-employment taxes are going to change a little bit. Then remember how we talked about carried interest, right? Steve, the sponsor, they kind of made this compromise. You got to hold it for 3 years, except for rental property for now. They want to just knock that whole thing out of the water. And they're talking about slaying our favorite tax code, the 1031 exchange, which is like the most egregious possible outcome ever. So yeah, when we think about it, appreciated property, right? So in the past, right? So, property received by inheritance is excluded from income to the recipient under Code Section 102, and also by gift and device and bequest, so on and so forth. What they're saying now is if that happens, that becomes a realization event. You bought this piece of property for $100 back in 1900. And so now in 2020, it's worth 10 million bucks. And so you have like 9,900,000, you get the whole point. You get a huge capital gain just from the transfer, whereas before it was not, right? Now, they're going to keep the unlimited marital deduction in place. So if you transfer to your spouse or to a charity, that would not be a triggering event. And they'll exclude it for purposes of personal residence, $250,000 per person or $500,000 for married filing jointly if it's personal residence. The exclusion would be like $1 million per head as well in a married situation, or $2 million total. Family-owned and operating businesses won't be subject to it unless they stop being family-owned and operated. And so anything, and then the last thing too is they say, hey, if there's a property that hasn't faced a recognition event in 90 years, then they want the income. They want the income at that point. They don't want you to hold it on forever and ever and ever and ever. And this is typically held by like a partnership or a trust that hasn't disposed of the asset. They want to have a triggering of an income event at that point. The next one, we all love our S corps too. And a lot of CCAMs, most of us have brokerage backgrounds. We love our S corps. Absolutely love them, right? Because of the favorable tax treatment that you can shield most of your income from from self-employment tax. There is discussion about nixing that as well, and so that the income passed down to you as an individual from your S corp would still be subject to self-employment tax, which would actually make S corps not fully antiquated. I'm sure there's some use for them, but the amount of S corps out there would be greatly reduced. And by the way, I think it's one of the most common business tax returns to file in the United States is an S corp. So you might see those drop. And then we'll keep going. And let's see, carried interest, right? And so if you're doing any type of work, it's like investment services, then they're going to count that as ordinary income. You don't get this wonderful capital gain treatment. They'll exclude any amount of income over $400,000. So presumably if you're running a hedge fund and you're super successful, you're probably making a lot more than that. They want all of that to be ordinary income, which sucks too, if you're a hedge fund owner. And then here's the worst one. This is all causing us panic. I feel like this one, if I had to take a guess, I feel like this one will not happen, but they're talking about repealing 1031 except for some small dollar amount. And that would really suck. So those are the changes. Sorry to be gloomy. It's very rare that I can give you tax changes. We go, hey, they're going to reduce all the rates to zero and they're going to give us credits and all that sort of stuff. But hey, here's where we're at. We're in a post-COVID environment. All the governments in the world are hungry for money, and so expect tax raises to come in the coming years. I just don't know exactly in which form it'll be yet. So with that, that concludes our presentation. We're open to questions, and we really greatly appreciate you guys taking the time to listen to all this technical stuff about partnership taxation and real estate syndications and all that. And I hope it really helps you guys out in terms of maybe if you're going to form your own, or if you already have some, maybe you can tweak around the edges a little bit and make sure you're not tripping up any of these crazy tax laws. So thanks again.
Perfect. Well, I'll start off with the questions. If anybody has any questions, please use the question and answers or use the chat. We're definitely monitoring that. But I have one. So let's go into the partnership. So maybe I can make it a little interesting. So we're going to have a joint venture with 2 sponsors, but one sponsor takes all the liability, takes on they take the recourse of the loan. What does that how does that work out for both sponsors?
Diane, want to take this one? Or I can.
Sorry, I was trying to figure out how to. Once I got booted off the share screen, everything changed on my screen, and I was trying to figure out how to get back. Sorry, Francis, can you go ahead?
No problem. No, look, that's a beautiful Q&A. Look at that. Wow. We have, I'll start off the first question. So we have for those of you who are involved in syndications, you may find yourself in a partnership with another real estate professional, or there's an opportunity for, let's say, 2 sponsors to come together. One raises their money, the other raises their money, but they come together in a JV, joint venture, as 2 sponsors. But one sponsor actually has the balance sheet to actually guarantee the note and make it recourse only to that one sponsor. How does that tax treatment affect the other sponsor who didn't take the recourse, and because there are in fact 2 sponsors?
Right. So at the end of the day, a lot of IRS rules are going to say, hey, look at the economics of the deal, right? And so if you have one sponsor who's taken on the economic risk of loss, hey, they're getting that basis and they're getting that liability. And so even with allocation of income, a lot of times the answer is always going to be look at the economics, make sure that, you know, the tax follows kind of the economics of the deal. So, you know, that's kind of how it goes.
Perfect.
And so we'll always ask those questions too, as we're doing kind of partnership tax returns. You know, we'll oftentimes ask, hey, you know, we see this liability, who is responsible for it, who took that on, what kind of loan is it? Those are all questions that we'll ask our clients to ensure that, you know, we're allocating that liability correctly.
Perfect. Thank you. We have one question. Will the presentation be available to watch again? Yes, it will be. It will be on our YouTube channel. For those of you who don't know that CCIM Greater Los Angeles has a YouTube channel. We are the future Los Angeles YouTube commercial real estate community. Stay tuned. We're going to be very active. So with Stefan and Diana, with their series, I mean, it's all going to be there. So any other questions? Anyone else? I think we had some comments. Great class. Well, first and foremost, I think with the interest of time, we are exactly at 12. So we appreciate you, Stefan and Diana, for investing your time with us and our community. And I'm sure everyone got a lot of value in our membership. And for those who are going to watch this later, I know that this was an incredible class for people to really understand the tax implications and mechanics of what partnerships and syndications are all about. And I hope that this can inspire people and give them the confidence to go out and do more deals. We are in an incredible space right now where there's a lot of cash in the business, a lot of cash out there looking for deals, and it takes CCIMs and professionals like the people in this community to go out there and make it happen. So we encourage everybody to, you know, go out there and make it happen. And we have Carmela, thank you so much. And we want to just end with that. And we have some classes I'd like to share with you guys, some information that I want you guys to know about. We do have in-person classes coming up. Foundations for Success in Commercial Real Estate, that is happening June 24th and 25th. This is all on our website. Please take a look. If you haven't signed up for your CI 101 yet, sign up today. Start your candidacy. This is the type of quality that we discuss, this quality of content that we discuss in our classes, in our events, and in our community. So if you haven't signed up for our chapter, if you haven't signed up to be a candidate yet, make this an opportunity to invest in your education, invest in your practice, and get involved. And for those of you who have any tax, do we have a slide for Stefan and Diana? Do we have a contact information for you guys? If you want to.
Yeah, so check us out. Check us out at www.morrisadvisor.com. I'm going to put this out in the chat as well.
Yeah, please put in the chat. And DJ, if you please pull up their website, maybe share. There we go. There we go. To be able to give everybody access, we'll make sure we send out an email to everybody with Diana and Stefan's contact information. But thank you, everybody, for your time. And I hope you guys have a wonderful rest of your week. And stay tuned to the next webinar. Thank you.
Thanks, everyone.
Thanks, everybody.
Take care.